Welcome back to A Few Minutes with Marcia. My name is Marcia Clark. I'm the Senior Research Analyst for Warren Street Wealth Advisors. And today we're going to ask the question, is the stock market worrying too much about interest rates? Now before we begin, just the disclosure that this is my opinion based on evidence to the extent I can interpret it and should not be used as investment advice for any entity or individual. Well, let's begin by asking yourself what interest rates and who's controlling them. Well, the Fed is who we hear about. And what is the Fed's job? Well, their job is to keep prices stable, that's to manage inflation, and also to support the economy so that everyone who wants a job has a job. So if you're going to ask yourself, has the Fed raised rates too much? You should judge them based on their job. And if you look at the graphic on slide 3, they're actually doing pretty well. Unemployment is very low, not inflation creating low, but still definitely low, and inflation is low. So they are right in the bullseye, right where they want to be for the most part. So if you're going to judge the Fed based on their mission, you have to give them full marks. They're doing what they're supposed to do. Well, how does this work? Well, we'll talk for a minute about the federal funds rates and how it influences the economy. The Fed funds rate is the rate that banks pay to borrow money from each other. Now, why would they do that? That's because they need reserves on deposit with the Fed to maintain their capital requirements. But if they want to lend money to you or me to buy cars or houses or what have you, they need funds, so they will borrow from each other. So if the cost of borrowing to the bank goes up, then theoretically they're going to raise the interest rates for you and me. And if those rates go up too much, we'll buy fewer cars and fewer houses and the economy will slow down. If the Fed funds rate goes down, then the bank could reduce their lending rates for you and me, and we might buy more cars and more houses. And that's how it works. The thing about it is that the Fed doesn't control those rates. The banks set the car loan rates and the house mortgage rates based on what the market will bear, based on demand. So if there's no demand for money, it really doesn't matter what the Fed does. Those longer term rates aren't going to change. So what does the Fed think about their own job? Well, they think everything is pretty much where it needs to be. Most of the Fed governors right now think that rates should stay the same through the end of the year, though there are a few who think they actually should go up. And if you look out a couple of years, the trend is definitely up, though not a lot. Contrast that with what markets think. If you evaluate the Fed funds future using futures contracts, you can see that about half of investors actually think the Fed's fund rates will go down in the future. And this isn't what the Fed should do, it's what market participants think they will do. Why do they think that? Because the economic activity is not great, and that the rate may actually need to go down in order to support the economy. Who's right? Hard to say. Researchers tend to think that markets are better predictors than surveys. So if you had to put your money on it, people think rates will stay low. But we won't know for sure until the data is more clear. Now, one interesting thing about the market right now is the Fed only controls those short rates. It does not control longer rates. And the 10-year Treasury is a very important rate that we hear about in the news. The 10-year Treasury is well below 3%. And the Fed funds rate is almost the same. So in fact, in some parts of the curve, the short rates are higher than the long rates, which makes market participants uncomfortable. But the reason for that is not because the Fed's raising rates too high and is going to stall the economy. It's because the longer term rates are not moving with the Fed the way I described they should in theory, because investors outside of the US like our bonds. They're buying our bonds because the yield on our bonds, even at 2.5 or 2.7, is much better than they can get at home, which is somewhere near zero. So as long as there's demand for those longer rates, they're going to stay low, no matter what the Fed does. And that's why you see the yield curve being kind of flat right now. What do we do about that? Well, based on objective measures, interest rates are about right. There's not really anything the Fed should do differently. What should we do as investors? Just stay in the game. We're not going to win by walking off the field. So stay in the game, watch the data, and when it becomes more clear, then take some action. So that's been A Few Minutes with Marcia. I hope you find it helpful, and I look forward to talking to you again soon.